welcome to The Trade. Before we get into the charts that matter, let's have a quick look at what traders out there are watching. Starbucks suspending its forecast through the next fiscal year as new CEO Brian Niccol looks to turn around the coffee giant, which is struggling with falling demand for its drinks. The US Centers for Disease Control has said that one person has died and dozens have been sickened from E. coli infections linked to McDonald's Quarter Pounder hamburgers in 10 states. The IMF says the US economy will continue to provide most of the thrust for global growth through the balance of this year and in 2025, led by robust consumer spending that's held up through inflation and, of course, interest rates, and oil prices settling for the second consecutive session higher. Traders downplaying hopes of a Mid-East ceasefire, focusing instead on signs of improving demand from China, which could tighten market balances in the months ahead. Let's get into the charts that matter now. Of course, we are awaiting the US election less than 2 weeks away. Our traders expressing a view here. Chris Weston from Pepperstone joining me. What are you seeing, Chris? Because it looks like the bets of another Trump victory start to pile up somewhat.
Yeah, so I thought I'd use this opportunity to look at how people in different markets, different asset classes are currently expressing those views. I mean, obviously, when you look at the betting markets, the prediction markets, there is a significant lead now, implied lead by Trump. Obviously, the cynics out there say, some sizable individual bets, have distorted the markets. And some people have suggested that perhaps Trump's using this as part of the campaign, promotion, essentially to boost those betting odds. And then if you ever look at the average of the polls, whether you're looking at 538 or Real Clear, the swing states, the 7 battleground states are all in Trump's favour, but they're all within the margin of error, suggesting it's going to be very close. So, for traders, we're trying to understand, what's the propensity for, the president, who's likely to be a person president. That's one aspect. But then, really, I think what the other big issue, of course, is who's going to get control of the Congress, who's going to get control of the House and the Senate at the moment. And, I think obviously people are saying, well, if Trump gets in, then the chance of them getting a red sweep obviously increase as well, because they're going to get the Senate, the Republicans will get the Senate, and there's probably an even chance they get the House. So that has big, deep-rooted in implications into taxation and fiscal policy as well. But I think the first chart I want to sort of bring up is this idea about how much of the US dollar move recently. Sorry, I can't actually see the chart. I don't know
let's bring it up. There we go. Yep.
But I don't. Anyway, so look, I think that the fact is that we've had a dollar rally recently, and everyone says, well, if Trump's going to win the election, if the betting markets are anywhere near the money, then he can pass trade policy and trade tariffs without necessarily needing the backing of Congress. So he can do that through various orders, building on top of the orders that are in place at the moment. And obviously then we look at, obviously people saying that's going to be US dollar positive. It's going to be, we're going to see a rally in dollar CNH, offshore yuan, a rally in the dollar against the Mexican peso, and all these countries essentially that they're going to put this tax on. But, like we've seen euro dollar push below 108, and the chart here basically looks at euro dollar relative to the difference in interest rate expectations over the next 2 years. So there has been, that as you can see from the line, that both lines are going down. So one of them is showing that the expectations for interest rate cuts in Europe are increasing relative to what we've been seeing in the US, and that's pushed it down. So what this is telling me is I'm trying to ascertain how much risk premium is already priced into the US dollar, how much is priced into other markets, given that the betting markets have shown this lead for a while. And this is telling me right now for FX traders is that there isn't much election risk being priced into the US dollar at current levels. We can focus on another chart in a second that shows that all the betting at the moment is in the options market. But right now, all the move, 90% of the move, or maybe even more than 90%, 95% of the move that we've been seeing in the US dollar, and also what we've been seeing in the backup in 10-year treasuries, have been driven by growth expectations or the better data we've been seeing and rate cuts being priced out of the market. If you have a look at SOFR, for example, the secured overnight funding rate, the trough in interest rate expectations in the US has moved up about 70 basis points in the last couple of weeks. That's pushed the dollar up. Growth rates and relative growth rates have pushed up the dollar, not the election premium, which I'm seeing from this. So, if we were to see tariffs being implemented, and they will be implemented, depending on whether we get a red sweep or just Trump in the White House. I think the dollar's basically got legs because I don't think much of this tariff risk is being priced at the moment. That's my argument.
Chris, we both remember what happened on that day in 2015, right? 2016,
yeah.
Before he came into power in 2017. And the big moves that we saw in the Mexican peso. What is implied volatility telling you in that pair now?
Well, exactly. So, goes back to my point that in the spot FX market, there's very little action. There's very little being priced in, and that's right because 13 days or so in the FX market is still an eternity. There's still a lot that we can change, although it is getting a lot more focused now. But where everyone is focused in on is in the options market, and you can use different expiries. They have set dates for when the options expire. And the one tomorrow, we'll be able to use 2-week implied volatility to use in the options pricing. And that should spike up because the election then comes into that time frame. But the one that everyone's looking at the moment is options that expire in 1 month, 1 month's time, because that does encapsulate the election plus a bit more. But what we can see from this is that if we use dollar MEX as our proxy, because this is obviously one that would be affected by trade, China probably more so. You can have a look at dollar CNH 1 month implied volatilities, and they're at the highest levels really since 2020. The last election, of course. So while spot FX is not moving, we are seeing people, using and buying volatility through, obviously the sheer demand for options to hedge against this election risk, against this tariff risk. So we're seeing, elevated expected movement in dollar Mexico, Euro Mexico, Mex Yen, all the Mex pairs really, certainly in the CNH. And there's a little bit in the equity market. If you have a look at the VIX relative to 20-day realised volatility, you can see that they've moved a while. I don't think it's a lot. So what this is telling me right now is that all the hedging that's really being taken place against movement, against tariff risk is taking place in the options market, and people are using that optionality to hedge out. I think the spot market will catch on. I think equity markets will catch on. But I think, people are looking at betting markets and saying, well, we're not sure about them. We just don't know about the signal that we're getting from them. The polls are still very close, and that's probably what we'll look at much more closely, although there's still a cynicism about the polls. But just you know what, just in case, let's go and hedge ourselves in the options market. So I don't think there's a lot of election risk being priced into the market. It's really all being centered in the options market at the moment.
All right, what about gold? I mean, just basically being one of the key hedges here, not only with the election focus, but the Fed and also what we're seeing in the Middle East.
Yeah, it's interesting, isn't it? Because you've got a stronger dollar. The dollar's rallied 4% on the dollar index in the last couple of weeks. It's up against all currencies, typically a headwind for gold. You can chuck in real rates, which have been moving up quite sharply. Nominal treasury yields have been moving up quite sharply as we've seen better growth data coming through. And more supply coming into the market as well. The Treasury are issuing more increased amounts of treasuries, and both of these factors would typically be a significant negative headwind for the gold price. But if you have a look at the chart, we're making higher highs, we're making higher lows. We break out of a high, we consolidate, we push the previous range high, bang, it goes up. And you can see that just with the channel that we've got there, which is basically a regression. It's a line of best fit that goes through that really strong rally we've been seeing, and just uses some statistical data, standard deviation either side of that. And it basically just tells you if this trend that we're seeing continues, which I have no reason to believe it will or it won't, that these are the kind of levels where if it gets above that line, our risk profile changes. I wouldn't be chasing it above those. In fact, I'd be looking at scalps as a trader. But it's certainly, these are the levels statistically that you'd say that probably isn't, worth chasing at these levels. But the actual reason why gold's doing what it is, when you've got these massive typically negative headwinds for gold, is very much the subject to debate. Is this against geopolitics? Well, the oil price is telling us that we're less concerned about that from a market's perspective. Is it about a resumption of inflation? Well, we're not really seeing that in the bond market, to be honest, in terms of break-even rates. Is it to do with central banks around the world who are perhaps not less friendly with the US, saying, well, we've seen what happens with Russia being cut off from the dollar system. Perhaps we want to go and buy some gold, and the reserve manager's doing that. There's a whole heap of hypothetical reasons which are quite opaque, and we never really know the true answer to. But for me, this is just a momentum vehicle now. You're seeing the options market every time it moves higher. The options dealers have to, hedge their exposures by buying gold futures or the GLD. And, this is just a momentum beast right now. So, if you this is where it can extrapolate from a lot of the traditional correlations. Gold's up 32% year to date. Silver's up 50%. You would have taken that at the beginning of the year if you're a gold bull, especially when the dollar's stronger. So, it's just out and out momentum now. People are buying because it's going up. And I think those are the rules you need to stick by.
Yeah, I love your line. Not so much an election trade, but it just looks beautiful. Chris, thanks as always.
It's a thing of beauty.
Chris Weston from Pepperstone. That does it for this episode of The Trade. Be sure to join us again next time.